Here is the overview of today's gold market news. Gold price performance, price trends, and technical outlook. U.S. economic slowdown spurs gold demand as investors brace for potential Federal Reserve rate cuts. Shifting of global dynamics as U.S. focuses inward and Europe increases defense spending amid rising uncertainty. Let's have a look at the latest gold price performance, technical analysis, and outlook. After experiencing a down week, gold prices regained momentum and rose throughout the week. Spot gold started the week at $2,858 per ounce, finding support around $2,860. The price then climbed steadily, reaching $2,927 per ounce by Tuesday morning and hovering between $2,900 and $2,926 per ounce through the rest of the week, closing at $2,911 per ounce by Friday. Gold price is expected to consolidate between $2,900 and $2,926, indicated a bullish trend, with the potential to retest the record high of $2,956. Gold was likely to break above $2,950 and could eventually reach $3,180 if it maintains its upward trajectory. A survey of the market reveals a strong return of bullish sentiment. Two-thirds of analysts and retail traders expect gold prices to rise further in the upcoming week. Analysts cited stock market volatility, inflation concerns, and geopolitical uncertainty as key factors driving gold's strength. Political factors, particularly U.S. policies under the Trump administration, play a dominant role in driving gold prices. Political instability and uncertainties were fueling the demand for gold as a safe haven asset. The euro's rally and European fiscal initiatives were contributing to a weaker U.S. dollar, which benefits gold. Further declines in U.S. equities could push gold higher. Gold remains in an overall bullish trend, although analysts anticipate some exhaustion could occur at higher levels. In the long-term outlook, analysts expect gold to continue its steady upward movement, with geopolitical concerns and overall bullish technicals supporting further gains. Gold reaching $3,000 was possible with political volatility and economic risks seen as the catalysts. However, the precious metals rally, now above $2,900 per ounce, poses a risk. Gold's 11% increase in value so far in 2025 could indicate that the market is becoming overheated, which could eventually lead to volatility or corrections. A pullback in the market could occur if the global economic outlook improves or if interest rates rise faster than expected. Geopolitical chaos, U.S. domestic policies, and the trade war, tariffs and inflation, and recession fears would continue to drive demand and add further buying pressure for safe haven assets like gold. Gold could reach $3,000 if geopolitical volatility or a slowdown in the U.S. economy persisted. Upcoming events, such as the Federal Reserve meeting and U.S. economic reports, are key drivers that could influence gold prices. Analysts are closely watching the Federal Reserve's forecast and its reaction to inflation and economic data. The potential for a rate cut in the coming months is a significant factor influencing gold. Moving on, let's look at how the U.S. economic slowdown spurs gold demand as investors brace for potential Fed rate cuts. The economic growth in the U.S. shows signs of weakening, as evidenced by a 2.4% contraction in the first quarter of the year. Investors are increasingly focused on how central banks, particularly the Federal Reserve, will respond. The expectation is that the Federal Reserve will be forced to cut interest rates, which typically supports the price of gold, as lower rates make gold more attractive compared to other assets that yield returns. The contraction in U.S. growth and the potential for interest rate cuts are expected to support continued demand for gold, as investors seek safe assets in an uncertain economic environment. While it's too early to predict whether the U.S. will avoid a recession, the ongoing economic uncertainty will weigh heavily on investor sentiment. In times of uncertainty, traditional investment strategies may not provide clear answers, and investors may face challenges in navigating the markets. The most successful investors will be those who are well-diversified and sophisticated, as no asset class is entirely safe. In particular, currency markets and traditional portfolios may experience volatility, and the purchasing power of savers could be eroded by continued government deficit spending. Important U.S. economic data in the coming week, including the February Consumer Price Index, Producer Price Index, and the University of Michigan's Consumer Sentiment Survey, will be closely monitored. These reports will provide insights into inflation trends and consumer health, which could influence gold prices. Next, let's have a look at the shifting of global dynamics as U.S. focuses inward and Europe increases defense spending amid rising uncertainty. The U.S. government is shifting its focus inward, prioritizing domestic development over its traditional role as the global leader or global police force. This marks a significant change in global power dynamics, especially as geopolitical tensions, such as a global trade war and potential currency wars, are intensifying. The move is creating an era of increased volatility as the world adjusts to new global leadership. Investors are faced with a less predictable and more fragmented global landscape, which is expected to drive more demand for gold as a safe haven. While the U.S. is adopting more domestic-focused policies, the U.S. dollar will not be losing its position as the world's primary reserve currency. The U.S. economy remains relatively self-sustaining, with a strong capital market and financial infrastructure that supports the continued use of the dollar globally. In response to the changing global dynamics, Europe is stepping up its efforts, particularly in defense and infrastructure. A key driver of this shift is the announcement by Germany's Chancellor-in-Waiting, Friedrich Merz, who revealed a historic deal to increase military and infrastructure spending. The European Union also outlined a plan to unlock almost €800 billion for defense spending, signaling a major shift in the region's priorities. The UK also increased its defense budget, committing an additional £6 billion per year, which will bring defense spending to 2.5% of its gross domestic product by 2027. These announcements have led to a rally in European equities, as investors anticipate that this massive government spending will stimulate the economy and support stock prices in the short term. Just a few days earlier, however, Europe's economic outlook was more uncertain. Despite Europe's efforts to boost defense and infrastructure, the bigger picture of global deficit spending continues to grow, which could be problematic. The trend of increasing national debts and fiscal imbalances is driving populist sentiments and creating greater economic uncertainty across the world. While Europe may have the room to increase spending, the broader issue of growing global debt remains unresolved. This could lead to long-term risks for the global economy, as more countries turn to deficit spending to manage economic challenges, further fueling political instability and social unrest. The large stimulus spending plans won't automatically translate into smoother functioning capital markets in Europe. The US dollar will likely retain its dominance, and the US economy will continue to play a key role in global financial markets. Analysts view that the demand for gold doesn't guarantee that prices will continue to rise indefinitely. There has been a marked increase in the desire to hold gold as a safeguard against volatile market conditions. Investors are seen diversifying their portfolios, in part, to mitigate the risks associated with economic and geopolitical uncertainties.